Welcome to Empowered Returns, a show that surfaces forward-thinking real estate advice that investors and developers need to help them invest smarter and build better. Welcome to Empowered Returns. We're excited to be here with Eric DiNicola today from Winterspring Capital. Eric, welcome.
Thank you. Thanks for having me, guys.
Of course, and here with obviously with PT as well, co-host extraordinaire.
Nice to be back together, Michael.
I know. I had to
missed you last week, buddy.
Missed the last
Probably
show.
Missed me 2 weeks ago too.
I did. Yeah, I did. I was very sad to not see you too much.
Yeah.
Yeah, exactly.
Right.
So,
Sure.
Yeah. Eric, how are you doing? I know we were chatting about you just recently taking a trip to Italy, but
I wish I was still there every day. I think I am, but I'm not. So doing great otherwise, though.
Good. Back to business.
Back to business.
And that's
never ends, really.
Yeah.
Tried to end it over there, but it didn't. It followed me.
Yeah, you're trying to pretend to be ready for retirement already.
Yes.
Nice.
Exactly.
Italy's a tough place to beat, but I'm looking for my next trip back. But we are going to talk about today your background as a developer and talk about some of the projects you worked on. Really trying to dive deep into your, some of the cool things you've done and projects you're working on, including hopefully we'll talk a little bit about 100 Lincoln that we're working on together. We're excited to dive into that a little bit as well. But maybe just to kick us off here, you can talk a little about your background of getting into real estate development, and starting Winterspring Capital.
Sure. Yeah. So, I started Winterspring Capital with Nick Earls, my partner. We met in high school. Then kind of, we both were very interested in doing our own thing, not really working for someone else. We went to college, went our separate ways. I went to New Jersey, and then I worked in New York City for 4 or 5 years. Did some stock trading, worked at a tech startup, did sales there. And then, Nick came to me and, probably 9-ish years ago now, maybe, and said, hey, look, we should really, I think I figured out something. We should try to buy a rental somehow and get into this, and this is our key. Because, I would come up for holidays and hang out with Nick and stuff when I'd come home. So we saved up for a while, and that was kind of the plan. I was still working down there. And then this is, the condo market in East Boston, as you guys obviously know better than anyone, really started to take off like probably like the early teens, 2013, maybe before that. But that's when we kind of noticed.
Yeah.
So we figured out, okay, there's maybe an opportunity here where instead of buying a rental, maybe we can do this. So Nick found a 2-family in a 3-family zone, which is there's not many left over there now. But we were able to add a 3rd unit by right. And in the middle of this, I invested with them. We all kind of pooled our money. And then I moved back up here. And we turned it into 3 condos, exceeded projections when we ended up selling all 3 of them. And that kind of springboarded us into the next one. And nice. Then from there, that's kind of what we've done ever since.
Cool. And on that first one, did you have any other investors, or was it just your own capital and bank loans?
So it was bank loan, and then Nick's brother was involved, and then another friend of Nick's brother, and those guys actually swung hammers and worked on the actual project as carpenters. And Nick's brother was actually the GC on the job. So we were essentially, as a company, acting as the GC, hiring all the subs directly. So that was a different experience that we learned positives and negatives from.
Yeah. I think that's a good precursor to some of the other stuff we'll talk about. But like with your trajectory, right? So you started with that one.
Yeah.
And then I would say, fair to say, kind of like the big break was East Eagle Hill.
Yeah.
Right. So talk about that, because I love that story just for, like as the classic representation of like true bootstrapping, just like, hey, we're going to do this. Like, didn't you guys even live there?
We did. Yeah. It was
Oh, wow.
Yeah, this is
was good. I'm excited to hear this now.
Yeah. So it was a 2-family in a 2-family zone. So it wasn't going to be any by right change. But we looked at it. We saw a comp across the street, another one nearby where, these guys are doing like 7, 8, 9 units. And we were looking at the sellout comps, looking at the size of the parcel. And it was actually 2 parcels that totaled, well, I used to know it so well. I want to say now about 6,000 square feet, which, for over there is
good size,
pretty substantial. It was a long rectangular parcel. So we ended up buying that. And then the guy who owned it, it was a unique situation. We're going to again, we were moving in when we closed. It was like right at the end of the year, of whatever year that was now. And he was still in there when we came to, we had closed.
You took on roommates too.
Yeah, it felt like it. He was trying to stay, and he's saying, basically it's 2 units.
Yeah.
So I think there was a conversation, I can live upstairs. No, this is not happening.
That's awesome.
I didn't know that part.
Yeah, so we got in there, and he got out eventually, and he's a nice guy, just odd. And it's like his family's home. He's the last guy left, so it's a whole situation. So that was our entry into this. So we're living in it. We're paying the mortgage and everything. We're going through, started the zoning process, met with the neighbors, met with the local civic groups, and we said, okay, this is kind of our first foray into this ourselves. We had seen how it kind of worked and tried to learn a bit. But, meeting all these neighbors and realizing, these people don't really like you very much right away. And so we started with like a 9-unit design there, and we were really seeing dollar signs like, wow, this is really going to work out great. And the family right behind us was a local politician's family, and then he lived 2 houses over. So we started working with him right away so that we could kind of have a good foothold in, and the neighborhood all trusted him and everything. So it wasn't like, we were trying to go against the grain. And, it was a long process for us to learn how that worked. And we eventually came to 7 units, had a bunch of meetings with the Civic Association over there, the Eagle Hill Civic. And finally, in the last one, when they voted on it, it was a unanimous vote for us and for the project, the 7 units, which was still really profitable. It was going to be for us. And someone stood up and said, wow, this is the best project we've ever seen through here. No one has listened to us like you guys did. So we're thinking, wow, we're just going to keep repeating this. This is amazing. And so that project worked. It took a little while. Then we sold all 7 units, and it was great. And we thought, we'll just repeat this. And then got a lot harder from there. That was kind of a unicorn.
Yeah.
It's like they say the guy who goes to the casino wins $5,000 in 5 minutes, and then he's stuck for the rest of his life,
Yeah.
Got the bug.
Yeah.
So like you approached that, so that was a 2-family.
2-family.
Okay. And I think, some mistakes get made, right? So like you guys obviously saw some upside, but how did you kind of look at that to make sure the downside's protected, right? Because there's no guarantee you were going to get 7.
No,
you obviously went in at 9, right? So when you look at deals like that, like what do you think would have been the catastrophic scenario there, and would it still have worked for you?
So catastrophic would have been, not getting approved for anything beyond the local zoning, which was 2.
Okay.
So worst case, we were thinking we'll just have to resell this thing. And other developers who would have been the potential buyers of stuff like that would have known at that point, and it probably wouldn't have been as simple as just doing that. Yeah, prices kind of kept going up, but there would have been this caveat, the neighborhood already denied this. So the way we looked at that one was, okay, yeah, it's a 2-family, but it's surrounded by triple deckers. Worst case, maybe we could probably get approved for a 3-family. Our parcel's bigger than these existing ones. And that was kind of our fallback scenario.
Okay. And how did you guys think about, or how did you learn to, underwrite a deal, look at what the opportunity may be in a given property? What was it? Was it just learn as you go, or did you have any sort of experience with that? How'd you get going?
It was probably learn as you go. Nick had a background in commercial real estate. He had been selling commercial real estate for a bit going into that point. That's kind of how he got into this idea in the industry. And then, I had done a lot of financial modeling in my old jobs. So I went to school for finance. Yep. So we kind of tangentially were related to some of this stuff. And, we just figured out, he had access to MLS initially because he, had his license. And so we used MLS, and we'd look at comps and we'd see really just kind of input, output, like, okay, this sold for $600 a foot. This is how much we're paying. This is how much it's going to cost us per foot. And then as long as there was a decent difference there, at first it was really that simple.
Yeah.
And it worked out. I don't know if, that was the best way to go about it, but
awesome.
Early on it worked.
Yeah. So you guys really just kind of caught the bug. You made some good early returns, and then what were you guys thinking as far as your growth trajectory from there? How did that evolve into your next deal, a couple of deals, and really kind of lead to the growth that we're seeing today in Winterspring?
I would say we wanted to, we saw a couple other guys similar to us at our experience level and age and kind of growing, and we're saying, okay, we're doing multiple projects at the same time. So that was to us like, okay, how do we do this? And we started to, we took that, the returns from that, went into a couple other projects. Both ended up being smaller, one in Somerville, and then eventually one in JP, I think was at the same time, sir. No, so Somerville was another situation where we fought the neighbors. It was kind of our first really bad fight with the neighbors for a couple of years. And the zoning was changed on us while we owned the parcel. So it really as a whole, you might remember, we might have mentioned this to you a while back. Yeah. So where was I going with that? Oh, the point was it gave us the ability to say, okay, instead of focusing on one at a time, we're going to try to do multiple and we're going to try to go, big. At that point to us, we're thinking like 10, 20 units is big. And it is sort of depending on what you're dealing with. So that led us to doing multiple projects at once, and none of them at that point yet were really bigger than the 7 units. But it gave us the ability to do these multiple projects at once and then realize, okay, if we want to do it this way, we're going to have to also bring in outside capital. And that was kind of when it dawned on us, oh yeah, there's no way you can do this yourself, roll everything over, live and keep funding it. So that's when we started realizing we got to bring in outside capital.
Nice. Awesome. And I'm assuming your background in finance sort of helped you kind of create that the model, how you were building your investor base and capital stack and how you were kind of modeling all that.
I think so. I think it helped. I mean, I'm lucky in the sense that my partner, Nick, is very like an entrepreneurial guy and he has a good big picture view of everything. I'm kind of like more of like an operator type. So we kind of use those and then some of my skills from finance. And it took me a while. I remember thinking, oh yeah, I studied all finance in college and everything. And no one took all these, securities valuation courses and all these things. And no one ever just made it clear the fundamental kind of view of what a business is to me. And you just kind of like jump past that. So once we really got into it and realized, okay, you have all these expenses, you have revenue coming in and, whatever the difference is, you get your profit. It's simply put, very simply. But once we kind of got onto that as a big picture, it was able to help us look at things very differently and more systematically. And that's when we, I think, wrapped in these investors and everything and realized, okay, we have a system here that we don't have to do 2 4-unit projects at once. We can really start going for, 3 to 4 projects or 1 30, 40-unit project or bigger.
Yeah. Awesome.
Yeah. So as you guys have kind of evolved into the bigger projects, I think one thing that you've done really well is you guys have had a really big presence on social media. You guys are very active, very engaging, really good content. How did you use that as part of your strategy for capital raising and, kind of as you've gone from the smaller projects to the bigger projects, you kind of reference that you're really looking at this now as more kind of going in the more long-term ownership direction and more on the apartment side. Obviously, we've got 100 Lincoln, which is a big condo project. But, after that, I think you've, made it clear that you guys are looking on the multifamily side.
Yeah. I'd say the way we use social media, we kind of have a philosophy like we saw some other people doing it, essentially. And we do this with a lot of stuff where we say, okay, A, there's no reason we can't do that. But B, it's clearly working in some way, so we should be doing it. And so we kind of saw that this was the way things were going. People were using Instagram and LinkedIn. And we had kind of, gotten out of that just, like on a personal level. We just kind of like fell off the map with that stuff. But then we, once we had this kind of realization that we need to use it, and this is where a lot of this stuff happens, I think it really helped us. I'd say a ton of our networking now is through LinkedIn. We do a lot of these posts like you're talking about where we try to put something out there that's a really valuable thing. And it's, you know, it's the goal is to get reaction, so people will come to us and ask us, or we can like you know, form a new connection or whatever, and in the future hopefully it helps the business. But kind of our mentality, like this karma economy thing, you put out info as much as you can and have hopefully people learn from it, and then no pressure on them to interact with you, but if they do and they want to, otherwise you just did something good and your name's out there. And
Yeah, I think it's one of those things where, you know, adding value to people is always the right option. You know, adding value to the world, because you're gonna get it back. You're gonna just either by leadership and thought, you know, sort of thought leadership, putting your opinions out there in the world and your knowledge out there to the world. You're right. It's gonna absolutely come back to you in spades. You know, and you guys, I would commend you. I know you guys put out good kind of like webinar, like detailed webinars, market reports, and like really good. It's not just like a pretty picture next to a building. You know, it's some really good high quality content. So I have no doubt that you are.
Thank you.
That's well received for you guys.
Yeah, we also now, the guy kind of running the investment side of things, Kyle Stahl, he's another guy from Zavarian. I've known Kyle since we were like 12. We grew up right down the street from each other. And so Kyle had a very good sales background. He's very successful. He had multiple sales roles that he's really good at, and we were trying to get him into the company for a little while. And so once we brought him on, and we combined that with this social media thing, he took this over kind of in terms of like these webinars you're talking about, and gave the webinars. And we were just talking this morning, all three of us are meeting about it, and he's doing another one now. And we're trying to say, okay, like he's giving all this good info about the state of the economy right now and interest rates and everything. And then, you know, he's trying to figure out how do we, this is great. These are facts of what's going on, but how do we kind of present this in a real estate lens so that people who are looking at it can understand, oh, this is what it means for me, or if I want to invest in real estate, this is what that means for me.
Yeah, I mean, I can only imagine how much that builds confidence in your already investor, your current investor, but new investors or potential investors, and just, you know, by showing them you guys are, you know, essentially experts on the market. You guys are accomplished and doing good things. I mean, you might not have all the answers, like no one does, but at least they know, and you can see you sort of learning and growing and sharing that information as you guys are using in your own business that you can share to the world. An investor maybe it's not a perfect investment for them every time, but they'll be coming back around and see the next project and the next webinar, and then finally you get them as an investor, right?
That's right. Yep.
Yeah. So it's a good strategy, and it's a good way to attract people that might be outside your network or ancillary, you know, friend of a friend, or, you know, connection of a connection type of thing. So
that's something like LinkedIn, literally with the multiple levels of connection, that exact scenario happened. Yeah.
Yeah. How have you seen that sort of climate change of late, as far as, you know, your capital stacks and deal structures, and, you know, getting investors and sort of the dynamics within that, and how is that impacting your business of late on the current deals?
It's definitely impacting it, obviously. Yeah. It's the first thing, you know, everyone thinks about in real estate now is the rates. Obviously, it's a very clear cut thing, and they affect everything, because if you're talking about, you know, a large building and you're going to get a construction loan, I mean, you're talking millions and millions of dollars. So every percentage point is a massive amount of money that it's in cost to build the exact same, or to, I guess you should say, to borrow the money to build the exact same thing that it would have cost. Then it would have cost, you know, 5 years ago or 3 years ago. So the interest rate, massive for us, but we're also noticing in conjunction with that, which you probably hear from a lot of developers, the leverage on the loans, you know? So it's like, we've had some really, really high leverage, which we like better loans, because it means less outside investment, which is a little easier to just control than when you're dealing with mostly debt. We've had really high leverage ones that, you know, 90+% loan to cost, that now wouldn't even be nothing would get even remotely close to that. So
were you in like the mid 60s?
Yeah, in the 60s, 65 on new construction. I mean, a couple rental properties we deal with, we can still maybe get 70, right? Yeah, 75. But it used to be, so like one of the like East Boston examples, it would just be as simple as, you know, 70. You put 25% down on the property, get 100% of the construction loan funded. Or now with the bigger stuff, it's all wrapped into one total project cost, and maybe you could do an 80% on that. Or in our lucky cases, sometimes we had the 90. And not all developers want to do that. Some prefer bringing equity, and they'll do 65 anyway and fill the rest with equity. We just look at it like if we can get really high leverage, it's just one capital source we're paying. They're probably, even if they have a really high interest rate, it's probably still going to be less than what an equity investor might expect.
Yeah.
And then, like I said, just less of a sphere of people involved, parties to deal with. So, yeah, the leverage thing for us, I'd say, is a big thing we're trying to deal with. It just increases the amount of money we need to bring to the deals.
Yeah. And do you guys typically, when you're, building the equity side, do you guys typically try to work with fewer, bigger pieces, or like a lot of smaller investors, or both?
We've done both. I'd say the majority of projects that we have investors involved with have been a more smaller or medium size than, say, like one or two big. They both have their pros and cons. It kind of goes against what I just said, like, less parties is simpler to deal with. But then a lot of times you get a big investor, like an LP firm or something, and they put the entire $5 million you need, and now it's, you're basically controlled by them, which we kind of want to avoid. Because it's like, you think, that means maybe less work for us, or maybe we can be more efficient. Someone else, but that ends up being the opposite.
Right. Yeah.
Certain things you don't need to report on, that one window is crooked and it'll be installed next week. They need to hear about it.
Yeah.
So
interesting.
Yeah.
And moving forward, or I guess looking back and moving forward, you guys have typically done the condo projects to kind of generate, current cash flow for the longer term investments. But what is your typical, when you're looking at multifamily, what's your typical hold period that you guys are trying to identify?
Well, I think for a lot of these projects, if we can figure out a way to hold them indefinitely as a company, we would do that. Some of them, it's tough to make that work because you got to bring in outside capital. They don't necessarily want that. They might want a 5-year period where you build for 2 to 3, stabilize, and then sell. So that's, I'd say, typically 3 to 5 years if we're going to sell the finished apartment building. But if we want to hold on to it, at least 5.
Yeah.
And then we have a couple small rentals outside Boston that we're just, holding indefinitely and sort of continuing to build that business up on the side.
Cool. And I think I've noticed too, you guys have been, at least potentially, and maybe we're looking at other geographies outside of Massachusetts. I don't know if you're still doing that, or where you guys are at with, sort of geographic diversity or not, given the way the market has sort of went one way, then come back the other way.
Yeah, we were for a little while. We probably dedicated a whole year. We were still doing our projects up here in our backyard, but we probably dedicated a whole year to looking at like the Southeast, specifically the United States. And we just started realizing, even before interest rates went back up, this is when they're really in the lowest, over the last couple of years, like cap rates were flying down there, like dropping off a cliff, and then rents were skyrocketing, and we're just like, this isn't really, I don't know, is this sustainable?
Right. Yeah.
And people were overpaying. We did put in an offer on a big thing in Georgia. It was like 200 units, and the group that we've kind of figured out that ended up buying it came in way above asking, and we did the math, and we're like, they're paying for a cap rate that's not going to exist for like 3 years until they do all these renovations, and they're already kind of tight renovations. So we were just seeing that more and more and more stuff was going so quickly down there that we almost had missed the boat, and it was too risky.
Yeah.
And we said, let's just focus back on our area.
I think it's one of those fascinating sort of things that, obviously a lot of that was COVID driven, the relocation, work from home, and a lot of migration from the north to the south, southeast, and all these things. But yeah, it was wild to see some of the prices, the way they were, the rents appreciating, and just the investment capital flowing into those markets was wild. And so, I know a lot of the early kind of investors have made some good returns, but there's a lot of people that are underwater right now that have dove in late in the game. And as that market has corrected, as this sort of net migration has sort of moderated or sort of resolved itself post-COVID now. So it's fascinating. But, obviously there's opportunities everywhere, right? Real estate's so local, but I still think there's something so unique about this sort of Boston, Massachusetts area in so many ways that
strong.
is what keeps the market so strong and stable in the long run. That's what, sort of builds a lot of confidence in us. And I think a lot of the investors are working now. It's an expensive market, which is the challenge, which is sort of maybe good and bad. There's barriers to entry, obviously, and things like that. But it's interesting to see what kind of opportunities evolve over time in different parts of the market and different geographies. So it's interesting with your perspective on that.
Yeah. Yeah, it was we would see stuff like we'd get OMs from brokers who are marketing a big deal, and they'd be like, average growth rate over the past 5 years, rent is 10%, and then they just apply that every year
forever
going forward.
Yeah, of course it's going to happen.
That sounds
That's amazing.
That never changes.
No, it's that simple too.
Yeah.
I know that we always talk about how like hyper local all these markets are. Like even within Eastie, for instance, there's probably 10 different submarkets if you want to get granular. And that that's just one neighborhood within Boston. You guys have started to expand out to like the Worcester area.
That's right.
We're pretty pretty bullish on Worcester too. What are you seeing out there, and what are other markets that you guys are really kind of aggressively targeting right now?
So, Worcester is one. We have an approved project out there, 110 unit apartment building with it's a mixed use building, it's a couple commercial spaces, and then Lynn also. And really, as developers, you want to see like actual fundamental metrics that say, oh, this is a good area, like population growth and these type of things that we look at, and job growth and new tech and biotech companies coming into these areas. And so we obviously look at that we wouldn't get into anything without kind of the fundamental backing if we're going to explore what we think is kind of a new market. But the other thing about those two cities was and still is, there's a few changes very recently, but very favorable zoning code, especially compared to what we're dealing with in Boston. It's very clear. They say that, look, it's not this simple, but more or less, here's the downtown area. You can basically build whatever you want here, and you just have to work with us and make sure, look good. So you could go downtown. I oversimplified it, but you can build like a 10-story building in some of these areas. There's no real like Boston kind of has the FAR, floor area ratio, as their density kind of metric, and some of these don't really have that. They'll say like, you can go to every lot line. You can go up to 150 feet in height, which would typically be around like 15 stories or so. So it's just so much more. There's so much more in terms of flexibility with building. So when we see the fundamentals are good in those areas and prices are going up and rents are going up, then you add to this much more efficient zoning process. It was like a no-brainer to us. As long as we could get the numbers to work, and then we start seeing other developers prove these numbers working, we tried to jump in. Yeah.
Nice. And you have the what's the status of the project that you have entitled, and we said 110 units in
110
Worcester,
in Worcester, so that's fully approved, full market rate. We've actually entertained a couple offers from other developers to buy it right now in its current status, and then if not, we'll build it. And then Lynn, a little earlier in the process, but it's all by right as far as the zoning goes, and we have early plans for somewhere around 100 units, be like about 6-7 stories. Similar deal. They're just an easier, or not as much easier, I guess easier, but more straightforward approval process. Right. You guys know there's almost too much subjectivity involved. Like it's not as clear. You go in. Oh no, that's here. This is you got ISD. Here's a new set of requirements. Like, where did that come from? That's not what it says on the zoning. So less of that in these two cities that we've seen. Okay. They kind of, and you meet with them, and they're not the department heads, the mayor, whoever we met with. They kind of want you to come build in their city, or at least that's the vibe they give off. Right. Which I don't always get around here. Yeah.
And so given the sort of experience and, you know, whether it's multiple geographies, different product types, different sizes, what are some lessons that you've learned over the years in terms of how to you know do an effective deal or you know, create an effective return on a deal or some problems you've faced and overcome?
Good question. A lot. I'd say there's a lot of this kind of generalized. I'll give a few specifics, but just at the top, realizing that we make mistakes and then looking back saying, okay, this is what happened, then don't do that again. Or we didn't do it this way. If we had, this would have happened. Let's make sure we do it this way now. So, I mean, just kind of, I guess some examples would be trying to look at things from like an 80-20 perspective with certain things. Like, okay, we spent so much time worrying about the finishes in this specific part of the building when really, you know, that's not our skill set. That's not our expertise. Let's just make sure the big picture, get the building done, and then we'll bring in people who know that better than us and who will honestly make a better decision on it than us. So just kind of realizing where to spend our time. We've got better and better at that, bringing in professionals and experts on certain areas that we just, you know, maybe some developers think they can handle and they can't. And I think just like early on when we were like that very first project in East Boston, the small one, we, you know, we're hiring subs and some we just get out of the phone, you know, off the internet basically. And that's a big thing we learned. You know, it takes a while. We're not even that old. We haven't been doing this that long, but we've already slowly over time built up a lot of relationships. And then those relationships have given us subs from other groups or whatever. And recommendations for, oh, you should have this done or this, you know, bring in this guy to help you look at the building envelope, stuff like that. That's really, I think that's a huge lesson for us, accepting that. And then anytime there's an opportunity to meet with someone, kind of taking them up on it and just being open-minded about everything and realizing we don't know that much and we have to, there's always someone who can kind of give us insight into another part of the business.
Yeah, I mean, that sort of speaks to a point that we always, you know, I actually always try to sort of think about this in our own business and our own, you know, lives, as well as to, you know, there's people you can bring in. You can assemble a team that can help you do things in a much more powerful, faster, streamlined, better way. And there are people with expertise or companies or vendors that you're going to hire with expertise that you don't have. And the powerful thing about that, when you as a, you know, the sort of visionary as a developer in this case can bring the best team together, you're going to get the best results. Yeah. It's not about doing everything yourself or, you know, micromanaging every little aspect of it. When you can bring in a team that you trust and vendors and professionals that you trust, it can really lead to a much more powerful and less stressful experience, frankly, at least from my perspective. I don't know if you feel the same way.
I do, 100%. And that's, I feel more and more that way by the day. It seems like there's always examples of why that was the best choice to make to build a team for this or that. And it's like, you know, like with you guys as an example on Lincoln Street, I was telling you this recently, PT, that, you know, we all have our real estate licenses. On some of our smaller projects, we would sell the units.
Right.
But it's like, we couldn't even fathom trying to do that with this type of building. You guys have the extreme expertise in that market with buildings like this. And even if somehow magically we could get enough buyers in through our, you know, there's so many units, we just can't handle that. And that's like a very clear cut example. But then there's even smaller ones where it's like, oh, you know, we should have someone come in and kind of, a third-party plans review or something. It's not the architect, it's someone else, and you think, you know, we don't really need that. And then you get to the end of the project, you're like, wait a second, this door doesn't open, or hits this, or just minor things that if we had just done that, maybe it cost a little money at that point relative to the project.
Right.
But then we finish faster, and then we make more, and by finishing faster, you make even more because you're paying less interest, and it all adds up, you know?
Yeah, absolutely. Well, maybe we can chat a little bit about 100 Lincoln, since we're, you know, depending on when this podcast gets released, we're just about ready to start sales over there, which is exciting. Yeah, let's do it. Yeah,
very exciting.
Maybe tell us a little bit about the background of the project, how it came about, and what the background, what the project is all about.
We actually bought it permitted, which I don't even want to know how long it took. I have an idea, you know?
Yeah. Years. We know years. It's just a question of how many.
Absolutely.
Yeah.
So it's a great location. It's in Brighton. It's across from the New Balance headquarters. Really a lot of hot units over there, as you guys know firsthand are dealing with. So a broker we know brought it to us. We tried to make a deal. It didn't work out. And then I want to say maybe 8 months, maybe even up to a year later, came back again, ready to make a deal. And so we did. And it took a little while to kind of, because of the whole buying it permitted, and there's a lot of mechanical kind of stuff with the actual contract and deal. It took a little while to put together, but then, the nice thing about that is once we did get it together, we weren't closing till we had a permit in hand. So we were literally able to put a shovel in the ground right then. Meanwhile, we had a 3-unit project in Savin Hill that was under like a 3-year permitting process simultaneously. It's just night and day when you're ready to go right after you close. And that obviously helped the financing and everything too, because they weren't taking on all this entitlement risk.
Right.
And so condos, again, great for the end user, for the homeowner who's buying them. Lenders, not quite as, from a construction lending standpoint.
Right. Yeah. Of course.
Not as, they're a little more risky to them than apartments. So we kind of learned that lesson from this, because this was, it's 32 units. So for us, that was by far our biggest project at that point. So it was a different financing structure. It was different than what we had been dealing with our smaller projects. It was a, one of these kind of total project cost, normal type of development ways of looking at the capital stack. And so, we ended up closing on it, starting right away. And, it's, 1.5 to 2 year construction process. So we're in the middle of it right now, as you guys know.
Yeah, no, and it's a great building, right? I mean, I think we did a really good job collaborating with you and Nick and the architects and really creating an awesome boutique building, right, at 32 units. It's kind of right on that, falls into that sort of market segment where, you're not 80 units, 100 units where you can go crazy with the amenities, but I think we were able to program that space in a way where we're really going to deliver a high-end boutique building to that area. It's all 2-bed, 2 baths, which it's interesting as that market has matured over, we've been selling new construction out there close to a decade now. And, the sort of preconceived notion, even as recently as probably 18 months ago, was like, oh, it's, the studios and 1-beds go quick, and the 2-bed. It's but like where we're going to be positioned in the market, all 2-bed, 2 baths, which is unique for a building to be all 2-bed, 2 baths, right? Usually you have a mix: studios, 1s, 1 dens, 2s, 2 plus, 3s. Like we're just straight down the chute with all these 2s, and a lot of outdoor space, right? A lot of decks, good layouts, good exposure in that building, right? The front's south. You've got. We're really excited about that project. I mean, I think, Rhodey's team did an awesome job helping, bring together your vision with our insight and the finished package, the amenity package. Again, and with everything you were talking about with the capital markets climate, particularly as it pertains to condos, like there's no pipeline right now, right? So
that's right.
We're gonna have, we're gonna have a very desirable product. There's still a lot of demand and not a lot of supply coming, so we're excited about getting moving on that.
Here I was thinking this was an interview, then it turned into a sales pitch. PT just went into sales mode.
I said he's going, and this is great.
Yeah, I mean, great developer,
keep going.
Phenomenal marketers,
fantastic, the best.
Yeah. No, but it is. It's a sharp looking building. We're excited. It's been great working with you guys so far on it, but and fired up to kind of really see this thing hit the market officially in a few weeks and get rolling. So as we can keep moving the construction line, hopefully finish up towards the end of this year. Awesome. What is on the condo project side? Is there anything that you've learned as far as doing a bigger project than you had in the past, or on this particular project in general? Have you learned some anything specifically compared to some of the smaller ones or some of the other larger multifamilies you've done?
Good question. Yeah. I'd say, I think I touched upon it a few minutes ago in a different question, sort of like the idea of the financing it, the lenders look at it from, again, from a construction standpoint, look at it a little differently. I also start to learn contractors look at it a little differently. Everyone deems it from a development side of things as a bit more risky. You know, you have to sell the units. If, from a bank, the bank's always looking at their downside protection. So I don't know what's easier for them. I think they think, if there was a giant apartment building that was an issue, they just take it over and rent it out. Whereas condos, they'd have to, they'd probably have to bring in you guys and sell the units individually. And it's just a different ball game. And when you're doing smaller condo projects, that's not as big of a deal.
Yep.
So kind of learn that. And same, contractors think of it as riskier because, maybe in the end you have, now you have a condo association. So if something were to go wrong or something, they would, maybe team up against you. So those are things that you deal with always in development. But I think we learned with the bigger condo building, there are just a few more things you have to consider and kind of protect against from the start that from a builder's standpoint that there weren't as big of, focal points.
Those are the things you learn over time. Like, obviously not pretty quickly too, when you're doing that project, that you just, understand how the different perspectives that the various stakeholders have, whether it's a lender or a contractor or another vendor or whatever it might be on these projects, that they take their different lens, especially in a shifting macroeconomic environment, in a shifting rate environment, in a risk, tolerance environment, and all these things that are happening. Was sort of a wild time to get this thing into the ground and start building it. So kudos to you for making it happen. And I think it's going to deliver on a really fantastic schedule for you guys to see good results in the project, and obviously it's well planned and being well built and well, hopefully well sold as well. So
yes, thank you. And hopefully, yes, that's what we're hoping.
Yeah. Yep. No, I'm sure we're excited to get it rolling there. And
great.
And PT's got the renderings right behind him right now. So hopefully we'll take a look at that.
If audience doesn't want to look at my face anyways, they might as well look at the pictures behind me.
If anyone's watching on YouTube, turn off your Spotify and turn on YouTube and take a look. Yeah. But no, it's been fantastic working with you for sure so far.
Yes, likewise. We feel the same way.
Anything else that we haven't asked you yet that we should be asking you, or anything else you want to speak to the audience about?
Yeah, I mean, we just kind of talking with these guys has reminded me of kind of how we started and what our mindset was originally. So hopefully, developers have been doing this a long time, can gain some insight that they don't already have, probably more than me. But if you're just kind of getting started out in it, really you can, like I said, we were going to buy a small rental and pool all our money, like 4 people. And, that strategy changed. And real estate's not necessarily easy to get into. There's kind of that barrier to entry at first because it's so expensive. It's not like you're buying a small thing. You're buying an expensive property. So people want to get into it. I know it's hard, but if you can figure out a way to do it and you really have a strategy and you combine or save up for a few years, pool with other people, you can make it happen.
Live with the seller.
Yeah, exactly. Live with the seller, no matter how crazy.
I don't think I've ever heard of that.
That was awesome. I did not know that nuance of that one.
He showed us too. I forgot it's a very key, important part in the grand scheme of things. He's very into mountain biking, which why would we ever know that? Because as soon as we went in, he tried to pull us all around his laptop and show us all these mountain biking videos, which was not at all what we were in the mood for and wanted to do, but figured I'd throw that in.
I can only imagine what, and I don't know if you actually mountain bike yourself, but I'd be terrified if I was 6'6" and riding a mountain bike down a road.
No. I don't think I'm doing that. I don't think so.
That's awesome. Well, Eric, thanks for being here with us on Empowered Returns. It's been a great conversation, as always.
Thanks for having me.
Yeah,
appreciate it, man.
Yeah, it's really good.
Appreciate you being here.
Excited to continue to work with you and keep it rolling. But see you in the next episode of Empowered Returns.
All right.
Thank you for listening to another episode of Empowered Returns. If you're a forward-thinking real estate investor or developer looking for actionable advice that will help you generate market-beating returns, make sure to subscribe on Apple Podcasts, Spotify, or wherever you get your podcast fix. I'm Mike DiMella with Charles Gate, and I'd love to connect on LinkedIn and further the conversation for any specific questions you may have. Thank you for listening.